Maya and Ben, young entrepreneurs, poured their souls into launching their design studio. Every late night, every penny saved, fueled a dream. Tax season arrived, an afterthought amidst the chaos. They'd heard whispers of tax breaks, assuming a comfortable refund. Then, the envelope. A stark, unforgiving notice. Not a refund, but a bill. A significant, unexpected bill. Disbelief etched across their faces. What intricate machinery had misfired? A subtle, yet powerful force had worked against them. Their friend Leo, a seasoned freelancer, offered solace and advice. "Did you write off everything?" he urged. "Every expense? That's the secret." He spoke of deductions with an almost reverent tone, a pathway to financial reprieve. A glimmer of hope, yes, but also a burgeoning confusion. Was writing off truly the ultimate answer? Or was there a deeper, more elusive truth shimmering just beneath the surface of his confident declaration? A critical distinction yet unmade. Deduction. Credit. The words themselves, almost interchangeable in casual conversation. Both promise relief. Both appear to lessen the tax burden. But in the arcane language of the tax code, they are starkly, fundamentally different. One, a subtle sculptor of your taxable income. The other, a direct, brutal weapon against your final tax bill. This crucial distinction, often overlooked, holds the power to reshape individual fortunes. It could have saved Maya and Ben. Or Leo. What hidden power defines this chasm? Myth number 1. The pervasive belief that a $1,000 deduction delivers the same financial relief as a $1,000 credit. It's all money back, isn't it? This is a trap. A widespread misconception that, while sounding intuitively logical, leads to costly miscalculations. $1,000 is $1,000, yes. But its asterisk impact asterisk within the intricate dance of the tax code is profoundly, surprisingly different. A difference with real consequences. Let's peel back the layers. A deduction. What is its true nature? It reduces your asterisk taxable income star. Not your actual tax bill directly. Envision a financial funnel. Your total income pours in, but a deduction narrows the stream, meaning less income is actually subjected to tax. Its actual monetary value, therefore, hinges entirely on your specific marginal tax bracket. A $1,000 deduction for someone in a 10% bracket yields a different saving than for someone in a 35% bracket. The impact is indirect. Subtlety is its game. Consider a household nestled in the 22% federal tax bracket. A $1,000 deduction doesn't magically slash $1,000 from their final tax bill. Instead, it means $1,000 less of their income is taxed at that 22% rate. The real-world savings? A mere $220. A fraction. This critical distinction often eludes taxpayers, leading to an overestimation of the deduction's direct power. The echo, not the shout, of financial relief. A calculation few truly grasp until the bill arrives. Now, turn to the credit. A force of an entirely different magnitude. This is not about sculpting income. This is a direct, dollar-for-dollar reduction of your final tax liability. No funnels. No bracket-dependent calculations. If you owe $3,000 and qualify for a $1,000 credit, your bill drops instantly to $2,000. Simple. Potent. A direct hit. Its power is immediate, uncompromising, and unequivocally understood once experienced. The direct strike of financial salvation. For that identical household, still in the 22% tax bracket, a $1,000 credit delivers precisely $1,000 in savings. No complex mental gymnastics. Just pure, unadulterated relief, directly off the top. The disparity in raw power between a deduction and a credit is stark, even shocking. Why then does this fundamental confusion persist so widely? What makes this obvious advantage so often shrouded in mystery? The raw numbers speak a truth many overlook. Let's finally draw a clear line between the two. A deduction prunes your taxable income, indirectly reducing your tax. A credit acts like a direct payment, reducing the tax you owe. The numbers are unforgiving in their honesty. A $1,000 credit, for the vast majority of taxpayers, is demonstrably 4 to 5 times more valuable than a $1,000 deduction. A profound truth. A distinction that can mean the difference between financial struggle and substantial relief. An awakening. Maya revisited their first year in business. They'd meticulously organized every receipt, tracked every single business expense. "We'll deduct it all," Ben had proclaimed, brimming with cautious optimism. Their focus, laser-sharp, was entirely on maximizing deductions. They missed it. The subtle, yet powerful, potential for credits. A missed opportunity now glaring back at them. The path not taken. The money left on the table. A painful revelation. The cost of incomplete knowledge. Myth number 2. Deductions are exclusively for the super-rich or for highly intricate corporate entities. They simply don't apply to ordinary people like us. This pervasive belief acts as an invisible barrier, preventing countless individuals from even exploring their rightful tax breaks. An imagined gate, yes, but its restrictive power is undeniably real. It implies a tax code that plays favorites, leaving the average person out in the cold. But is this truly the full picture? The reality couldn't be further from the myth. A vast array of common, everyday deductions exists. Student loan interest, contributions to health savings accounts, educator expenses for dedicated teachers purchasing classroom supplies. Even simple charitable contributions can provide relief. These aren't obscure loopholes for the elite. They are tangible opportunities for working families, students, and professionals to reduce their taxable income. The tax code, surprisingly, offers avenues for many. In 2022, an astonishing number of Americans, over 40 million, chose the simplicity of the standard deduction. Yet, beyond that, millions more proactively utilized itemized deductions, or specific above-the-line deductions like those for self-employment. This isn't data solely from the wealthiest zip codes. This represents a broad cross-section of society, families striving, students learning, professionals innovating, all actively reducing their taxable income. The hidden truth is its widespread accessibility. Leo, ever the pragmatic freelancer, meticulously tracked every conceivable business deduction. Every business trip, every software subscription, every coffee with a client, he'd meticulously recorded, convinced these were his ultimate financial shields. He believed deductions alone were his fortress against high taxes. Yet, even Leo, with all his diligent effort, was overlooking a crucial, more potent piece of the puzzle. His focus, while sharp, remained narrowly confined. A broader vista waited. Myth number 3. The belief that credits are exclusively for dire circumstances, or for deeply specialized groups the government explicitly targets. They couldn't possibly apply to *me star. This mindset is a silent saboteur, causing individuals to dismiss entire categories of potentially massive savings. It paints the tax code as discriminatory, offering a cold shoulder to the average taxpayer. But is this true? Or is it another layer of misconception obscuring profound opportunity? The reality? Credits are anything but niche. The child tax credit, the earned income tax credit, education credits for tuition and books, even credits for making your home more energy efficient. These are broad, powerful strokes of financial policy designed to benefit millions of everyday citizens. They offer substantial, direct relief, cutting tax bills and often putting cash directly into pockets. Not small programs for small groups, but economic engines for the masses. The numbers illuminate the truth. In 2022, the earned income tax credit alone was a lifeline, pulling millions out of poverty and benefiting over 25 million families. The child tax credit, another pillar, provided crucial support to more than 36 million families. These are not minor, targeted interventions. They are massive, foundational components of the economic safety net, touching lives across the nation. Their reach is vast. Their impact, undeniable. A force often underestimated. However, not all credits wield the same absolute power. Here, another layer of complexity unfurls, the distinction between refundable and non-refundable credits. A non-refundable credit can only reduce your tax liability down to zero. No further. Once your bill hits zero, its work is done. This nuance, a subtle but significant distinction, often trips up even diligent taxpayers. It's a powerful tool, yes, but one with a specific, finite limit. The full picture is still emerging. Then, there are refundable credits. These are the true titans of tax relief. They possess the rare ability to reduce your tax liability below zero, resulting in a direct cash refund, even if you initially owed no tax. A true financial lifeline. The earned income tax credit and certain portions of the child tax credit often fall into this category. They are not merely reductions. They are potential infusions of cash directly into your bank account. A profound difference. As small business owners, Maya and Ben had unknowingly qualified for specific startup tax credits related to offering health insurance and establishing retirement plans for themselves and potential employees. Yet, they remained oblivious. Their tunnel vision, fixed squarely on deducting every operational expense, blinded them to these direct financial injections. They were so busy building the ship, they overlooked the sails. The consequence? Lost capital that could have fueled their nascent venture. A costly oversight. Myth number 4. If a single expense qualifies for both a deduction and a credit, I should always prioritize the deduction to lower my income first. This common trap misinterprets the strategic interplay and critical order of these two powerful tools. It presumes a simple choice, when in reality, it's a calculated sequence. Ignoring this can lead to suboptimal outcomes, leaving money on the table. The illusion of a simple either-or masks a more complex, rewarding truth. The tax code operates with a precise, strategic sequence. It's not a free-for-all. First, you tally your gross income. Then, deductions are subtracted to arrive at your adjusted gross income, or AGI. Sometimes, more deductions follow. Only asterisk after asterisk this income sculpting process is complete do you calculate your total tax liability. And only then are credits applied, directly against that final tax bill. The order isn't arbitrary. It's a carefully constructed pathway. Why is this specific sequence so crucial? Because many critical credit eligibility thresholds are intricately linked to your adjusted gross income. By strategically maximizing your deductions first, you effectively lower your AGI. This lower AGI can, in turn, make you eligible for credits you might otherwise have been excluded from. It's a delicate, intricate dance between these two forces. A subtle manipulation of your AGI can unlock significant, direct tax savings. The key is knowing the rhythm. Imagine a scenario. You face a choice between claiming a $2,000 deduction or a $500 credit for an education expense. On the surface, the $2,000 deduction appears undeniably larger, more substantial. It feels like the obvious choice, but a deeper, analytical dive into the numbers, particularly for lower-income filers, often reveals a counterintuitive, surprising outcome. A hidden trap for the unwary. The apparent size can be deceptive. Now, the reveal. For that same student, if they're in a modest 10% tax bracket, the $2,000 deduction translates to a mere $200 in actual tax savings. However, the $500 credit delivers a full $500 in direct relief. The contrast is stark. This pivotal difference, often unnoticed, leads countless individuals to make suboptimal choices. The perception of a larger number can fatally betray the reality of its actual impact. A profound lesson in tax strategy. Leo recounted his own pivotal moment. One year, he meticulously optimized his business deductions, specifically to lower his AGI. His goal? To qualify for a critical healthcare credit. And it worked. By strategically reducing his taxable income, he unlocked a refundable credit that, he discovered, put more tangible cash back into his pocket than any deduction ever could. The elegant strategy clicked into place. The full power of the tax code, finally revealed to him. A true financial awakening. Myth number 5. Once I've identified a potential deduction or credit, my job is done. The IRS will automatically apply it in the most beneficial way for me. This is arguably the most dangerous misconception, breeding a passive expectation that the complex tax system will magically optimize itself. The tax code demands engagement, not assumption. It's a labyrinth, and without active participation, you risk being lost, leaving significant opportunities unclaimed. The burden, always, rests on you. The Internal Revenue Service, at its core, is a processing and collection agency. Their mandate is not to act as your personal financial advisor or to optimize your individual tax situation. They simply process the information you submit. If you fail to claim a credit or deduction you qualify for, or if you apply it incorrectly, the IRS typically won't intervene to correct it for your benefit. The responsibility, the onus, for navigating this intricate system falls squarely on the taxpayer. Ignorance is not bliss here. The consequences of this passive approach are staggering. Studies consistently reveal that millions, perhaps billions, of dollars in legitimate tax credits go unclaimed each year. Why? Because eligible individuals are either unaware they qualify or simply fail to actively apply for them. The Earned Income Tax Credit, a vital lifeline, has an estimated 20% non-participation rate among eligible filers. A staggering amount of money left on the table. The true cost of inaction is immense. A silent drain. Active, informed tax planning, understanding the subtle nuances, seeking professional guidance when necessary, these are not mere luxuries. They are fundamental necessities. This proactive engagement empowers you. It transforms the daunting, labyrinthine tax code from a source of anxiety into a landscape of opportunity. From potential liabilities, you can carve out significant, meaningful savings. Your financial destiny isn't passively determined. It's actively shaped by your understanding and action. The power is truly yours. For Maya and Ben, the initial shock of that unexpected tax bill slowly gave way to a profound, sobering understanding. It wasn't just a number. It was a glaring symptom of a deeper, systemic misunderstanding. They began to see, with painful clarity, how their singular, unwavering focus on deductions, combined with their ignorance of credits, had exacted a heavy toll. The mystery of their financial setback began to unravel, piece by intricate piece. The truth, finally, beginning to emerge. The grand distinction, finally, unequivocally laid bare. Deductions are the sculptors, shrinking the very income base upon which your tax is calculated. Credits are the direct carvers, directly chiseling away at the final tax liability itself. One is a reduction in asterisk income asterisk, the other, a reduction in the asterisk bill star. This fundamental, profound difference lies at the very heart of effective tax strategy. It is the core truth, the pivotal knowledge, the moment everything clicks into place. Armed with this newfound, empowering knowledge, Maya and Ben didn't dwell on past mistakes. They revisited their financials with fresh eyes, identifying previously unclaimed credits, small, but cumulatively significant. More crucially, they strategically structured their business for the upcoming year, actively seeking out eligible credits and understanding the optimal interplay with their deductions. Their unexpected bill became a hard-won lesson, transforming their financial outlook. A new dawn for their venture. Leo, too, integrated this deeper understanding into his freelance practice. His once singular financial shield of deductions was now powerfully complemented by the direct, striking force of credits. He began to advise his peers, not just on writing off everything, but on the crucial distinction, the strategic sequence, and the profound benefits of both. The mystery, for them, was finally solved. The fog had lifted, revealing a clearer path to financial optimization. A mentor, reborn. The myths are busted. The hidden truths, unequivocally revealed. Understanding this subtle, yet profoundly impactful difference between deductions and credits isn't merely about saving a few dollars. It is about financial empowerment. It is about seizing control of your financial destiny, transforming confusion into clarity, and unlocking the true, often underestimated, potential of the tax code. The knowledge is now laid before you. What will you do with it? The choice, and the power, is yours. The journey into the tax code often feels like navigating an impenetrable fortress. But within its formidable complexity lie powerful opportunities. Opportunities to reclaim what is rightfully yours. To build a stronger, more resilient financial future. Will you remain in the shadow of misunderstanding, passively accepting what comes, or will you step boldly into the light of informed action? The puzzle is solved, the map unveiled. Now, the adventure begins. What financial discoveries await you?